Yeah, it's not a problem.
Or no. I'd like to thank Ciccio Azzolini and Whitney Tilson, Valeria, and the VIS team for welcoming me here to Italy for the second time in 3 years, and for the first time as a presenter. And I know I stand between you and a delectable lunch, so I'll try and be parsimonious with your time. My name is Theron de Ris. I founded Eschler Asset Management several years ago, London-based, to manage an investment partnership. Grew up in the US, spent half of my university here in Europe, and my whole career, including a few years studying in Lugano, and also a few more working in Milan, so I really love Italy, and I'm happy to be here. But enough about me, let's jump right in here. Disclaimer. Okay, I'd like to start with a little quiz if I could. These are two asset classes. With rates of return in sterling. Bear in mind I live in the UK. This is 47 years, so it's an entire investing lifetime. Can anyone guess the asset class with the higher rate of return? Anyone? Real estate. Okay, here's the answer. First I'll give you asset class 2 with a lower 7.5% total return. It's the FTSE All-Share equity index. Asset class 1 is actually gold. And that's the CAGR of 9.1%. And I mean, basically, since currencies started free floating in 1971, gold has done better than the total return of the US stock market. And that might not be widely appreciated. The UK is, by most accounts, a first world country, but I will say that the pound has more in common with the third world currency. And I think the US dollar is, in some ways, not far behind. So have I changed anyone's mind on gold in the room? Didn't think so, but I'm just getting started. So we know that gold's long-term real return can compete, but in recent years it's fallen very hard, and more so for the companies that mine it. I mean, they've really been destroyed. And this is one of my favorite graphs. It shows the ratio of the gold stock index to gold over the past 28 years. And there's no denying that gold stocks are vastly below trend. They're near record lows, certainly relative to gold, which you see here, but also relative to the S&P 500, and on an absolute basis too. So the question is, why is this? And I'll just give you 3 reasons to start. The first is demand for physical gold is very strong, but it primarily comes from Asia. The traditional North American buyer of gold stocks is completely missing in action. So these stocks are orphaned, essentially. The second reason is, we've had nearly a decade of S&P 500 bull market. So the way to make money has been to buy traditional financial assets, including bonds. So who needs a classic alternative like gold or gold stocks? And the third reason is investors hate gold stock managements. And it's true that in the last cycle, a lot of value was destroyed, no doubt about it. But the thing is, that's basically backward looking. A lot of these managements have been replaced, and capital allocation is now quite sensible. In fact, the fundamentals of this industry have improved a lot. Just to give you one metric, over the past several years, these companies have cut costs to the extent that cash flow margins on a per ounce basis are up about 70%. Managers have been focusing on reducing discretionary expenses, curtailing expansion CapEx, cutting debt, and focusing on cash flow per share, as opposed to just production growth. Share prices haven't responded, but I think eventually they will. Okay, so gold stocks did rally hard in 2016, you'll recall, but they've been consolidating for 2 years. So where are we in this emerging bull market compared to prior ones? First, before I get to this chart, I'll say that since 1971, the gold mining index has had 5 60% peak to trough drawdowns. The worst was actually 84% between 2010 and 2015, and I'll come back to that. The average recovery was about 355%. So you basically kind of go like this over time, right? So these aren't compounders. This chart compares the current recovery of gold stocks to past recoveries in the post-war period. And so you can see that so far, at the peak of this current recovery, that's the red line, gold stocks were up about 136% above their trough. But right now, they're only about 70% above the cycle low. So there's really a long way to go if history is any sort of guide, on the order of 2 to 3 times. Interestingly, you'll notice that in each case, a large portion of the return comes towards the end of the bull cycle. So the astute gold stock investor, not saying this is easy, but needs to stick around for as much of that late cycle thrust as possible. And when it happens, it should be reasonably obvious to most of the students of psychology in this room, but that's actually when you might want to fasten your seatbelt on a little tighter, at least initially. Okay, so I'm going to talk about a very little company. It's a very small cap called Abitibi Royalties. The ticker is RZZ. It's the one on the left there. It's a cheap stock in a cheap industry, gold industry. And on my numbers, Abitibi Royalties' discount to NAV is on the order of 40%. Its peers in the royalty and streaming business trade well above NAV. It's a very attractive business model. And if the thesis plays out, I think we could see a triple play. We could see growth in NAV from resource expansion, see a narrowing of the discount, and an increase in the price of gold. So there's multiple ways to win with this little company. Okay, this is a picture of the largest gold mine in Canada, Canadian Malartic in Quebec. Produces about 600,000 ounces of gold per year. It's a mature mine with falling grades in the open pit. They're currently about 1 gram per ton. In the bottom left there, you can see references to some near-pit exploration zones, in particular East Malartic, Jeffrey Zone, and Odyssey North. And Abitibi Royalties' key royalty covers this expansion area. I'd also like to note that the processing mill at Canadian Malartic is the largest in Canada. So 55,000 tons per day can go through this processing mill, and I'll explain why that's important in a minute. Okay, so just a few stats on this little company. $110 million market cap, trades at just under $10 Canadian per share, 11.4 million shares outstanding. Current management took over 4 years ago. The CEO, Ian Ball, is a young, ambitious guy, former president of McEwen Mining, which is a New York Stock Exchange listed mid-tier gold miner. It's run by ex-Gold Corp CEO Rob McEwen, who's well known in the industry. Mr. Ball, along with the board and Rob McEwen, own about 17% of the company. And the company's key asset, oh, by the way, $42.5 million in cash and securities. I'll get to that. The key asset, in addition to the cash and securities, is a 3% net smelter royalty covering the Odyssey North portion. That's the expansion area on that picture I showed you of the Canadian Malartic mine. And there's also 22 other smaller royalties. So just a little bit of history here. In 2014, Gold Corp tried to bid for Canadian Malartic, which was owned by Osisko Mining. They were outbid by a joint venture between Agnico Eagle and Yamana. Now, because of an historical earn-in, Abitibi Royalties owned 30% of Malartic CHL, separate entity in which all the exploration zones were. And in February of 2016, Abitibi Royalties was able to negotiate a swap of this 30% interest in the exploration zones for this 3% net smelter royalty. And they also, as part of the package, received $35 million of shares in Agnico Eagle and Yamana Gold. So that's what created the current capital structure and the current opportunity. Okay, so why is this company so interesting? 3 reasons. Attractive business. Second, management I think is quite capable and innovative. And third, it's cheap. So first on the business, I don't know how many of you are familiar with the gold royalty and stream business, but it's very attractive. The royalty company, this is a primer, doesn't produce, but rather extends capital to mines that need the capital to bring their mine into production. So it enjoys the upside exposure to the success of a mine without the associated capital to sustain or grow it. So the NSR is basically just a percentage of the top line that the royalty company receives in exchange for an upfront payment for the life of the mine, but without the associated operating expenses. So think of this business model not so much as gold mining, but more as like, Qualcomm or Domino's Pizza. This is a very attractive business model. To give you a sense, the largest company in this industry, Wheaton Precious Metals, formerly Silver Wheaton, generates about $900 million in revenue, most of which drops to the bottom line, by the way, with 40 employees. So it puts Apple and Facebook and all these companies to shame in terms of revenue per employee. So the Odyssey North and East Malartic net smelter royalty is so valuable because the resource has grades that are 2 times the open pit, so about 2 grams per ton. And because the open pit production and grades are declining, the owners, Yamana and Agnico Eagle, are very incentivized to bring the mill into production. So that's what makes this royalty so great. It covers a high-grade zone next to a declining open pit with a lot of processing capacity, financially strong owners who need those ounces to keep Canadian Malartic moving forward. I'd also note that Abitibi Royalties has some other smaller royalties that come into production starting this year, which should allow cash flow to double before Odyssey North even comes into production, which is several years away. Okay, the second reason is the management. So CEO Ian Ball is taking a radically different approach to the typical gold mining management. So he grew up in the gold mining industry. He knows how tough this industry can be. And he moved to Abitibi Royalties because he recognized just how attractive the royalty business can be. And part of that journey, if you read his annual letters, which I highly recommend, was going back, learning from the best gold mining managers of the past, and also learning from Warren Buffett. He's read all the letters. And so the focus at Abitibi Royalties is primarily on organic opportunities as opposed to M&A, which dominates the agenda of most gold mining companies as the cycle picks up. And also the goal is to shrink the share count. I'd also mention that Mr. Ball invests his after-tax salary in Abitibi Royalties stock. And the goal that he reiterates in his letters is to be the best gold company, not the biggest. He's definitely not the biggest. Valuation, I'm not going to get into the details here, but I do think the shares are worth, in a very reasonable scenario, 15 to 16 Canadian dollars per share, based on modeling out the likely production covered by the net smelter royalty, primarily from Odyssey North, using spot gold. I use a 7.5% discount rate. There's some other assumptions in there. What I would like to emphasize, though, is the risk-reward ratio. I think even in a bear case, the shares are undervalued. And that's, I think, a particularly important point. Even if you put in $1,000 gold, you can't get that much downside because the royalty comes right off the top line of the mine. There's no operating leverage. Okay, so what are the risks? I'd say, for me, I am quite impressed with this young CEO. He's a very independent thinker. If he were to prematurely depart, I don't know, get into politics or something else, I think that would be a risk. I think if Odyssey North production were delayed, that would be a risk. Ian Ball needs to reinvest the cash. It's a very cash-rich balance sheet. That's always a risk, capital allocation. And last but not least, gold prices could fall, and that would be unhelpful. But I would say much less so for Abitibi Royalties than for the average gold miner. Okay, let's move on to the mistake here. Okay, so let's just say my first experience investing in the gold industry was a trial by fire. So in late 2013, I became reasonably convinced that the precious metals industry had seen the worst. This was after a brutal bear market, which you can see there on the chart. Gold had fallen about 35% already. Stocks had fallen by twice that. They were, in my view, so cheap that they traded where they had traded 20 years ago, even though the price of gold had tripled. And you can see the area on the right side of the chart denoted by the red horizontal line there, which is where I kind of loaded up. So I thought these stocks could double or triple just to get back to trend. Okay, I also had some concerns, which by the way were misplaced, about valuation of the broader US stock market. And I was fascinated by this idea that during certain bear markets in the past, the fortunes of this industry were actually the inverse of the fortunes for broader financial assets, as gold stocks went up when the S&P went down. And these two charts show that during the 2 calendar years, 73, 74, big bear market, and 2001, 2002, when the S&P was down 30 to 40%, gold stocks tripled. So when they start from a low level, they can actually do quite well. One of the only sectors that can do quite well in an S&P 500 bear market. So to sum up, back in 2013, big collapse in gold. Gold stocks seemed like a compelling way to diversify the portfolio. And that's the kind of thinking that I justified to really load up on this sector. Okay, here's what happened. Over the next 2 years, gold stocks, having already fallen by 2/3, fell by another 50%. So at the trough, end of 2015, they were down 84% instead of 67% or whatever. And in the second half of 2015, you can see where that line starts just flatlining. It's like the industry just sort of curled up and died. It was a pretty depressing time. Anyway, my fund was down 16% in 2015, and it's in no small part because of the flawed execution of this investment. I mean, I'd put about 1/3 of my fund into this basket, and while I could deal with the volatility, you can imagine that some of my investors became quite agitated, but they didn't abandon me, so I very much appreciate that. Okay, fortunately, there's a somewhat happy ending here. 6 months later, by the summer of 2016, the gold stocks had nearly tripled. So while the payoff had taken 2 years longer than I expected, for better or worse, I'd been nibbling on the dips on the way down, and I'd maintained my position. And so when the turn came, there was a very big impact on NAV, wiped out the losses, turned what I thought was still think is initially a mistake in terms of position sizing into a strong compounded return. Okay, before we move on from the mistake, let's try and not let them go to waste. And what can we learn from this? And here's a few things I took away that the audience might be interested to hear. So first, if you're investing based on reversion to the mean, this can be very messy. Extend your time horizon, especially with central banks getting involved in the cycle in financial assets. Second, if you're trying to get into a cyclical industry near the bottom, don't go all in right away. Just because you've finished your research and have conviction doesn't mean it's the bottom. Third, on the other hand, if you've done the work and based on your reasoning, you are convinced that you're correct, and the market doesn't agree with you, you have to buy more. Otherwise you're dead. And number 4, and this could be frankly number 1, do me a favor and avoid debt at the company level and the portfolio level when you're investing in cyclical industries. It's just not worth it. Okay, so my book recommendation is called Capital Returns. It's a collection of essays by analysts at London-based boutique Marathon Asset Management. Many of you are, I'm sure, familiar with both that company and also this book. It was compiled and edited by Edward Chancellor, who is a well-known journalist. The book is, it takes some work to get through. Frankly, I'm still working on it. But every page packs a lot of insight. I think it's worth most investment professionals, taking good notes when they read this book. And when I started reading it this spring, it really resonated with me. The core idea is that asset growth or contraction at the industry level is an excellent indicator of future returns. So rapid, sustained asset growth often indicates overinvestment and low future returns, and conversely, asset contraction implies above average future returns. And if you give it enough time, leading companies in industries where assets have contracted are more likely to combine mispricing with recovery potential. And my approach to investing in capital-starved industries, mirrors this approach to a large extent, and the book articulates it better than I could, frankly. So this is what the capital cycle looks like, and of course you've all probably seen variations of this before. The sweet spot is kind of that lower left quadrant there, where you have backward-looking investors who still don't realize that an improving supply side will lead to rising returns on capital and share prices. So we've talked about the precious metals, and I think that industry, I believe, is right in the sweet spot on the bottom left of that diagram. Of course, Abitibi Royalties is a cheap stock within that industry, I think. Okay, just a word on theory versus practice when we're talking about investing with the capital cycle. Investing in out-of-favor industries invites a lot of career risk. In fact, that largely explains why entire industries get so mispriced in the first place. So there's some important behavioral traits, I think, necessary to successfully deploy this strategy. And two that come to mind just off the top of my head are, one, you have to think independently because for a period of time you're going to be swimming against the tide. And second, I would say, try, if at all possible, to invest long-term capital that won't be shaken out early or by volatility. The results could be quite high. It's a quote by Jeremy Grantham here. He wrote last year that there may be more alpha to be had these days by betting on massive macro-level divergences. I mean, think of the two-tier market in 99-2000, or today, for example, energy versus tech. Is that a big divergence or not? Then investing at the micro level, where competition has increased a lot. I mean, what are there, like 200,000 analysts sitting for the CFA exam this year? It's gone up dramatically. There was an interesting interview I just read with Monish Pabrai, where he talks about, 2 decades ago there being 8,000 US stocks. Today there's 3,500 US stocks. But what he says is, the number of what he calls high IQ eyeballs focused on those 3,500 stocks has skyrocketed. So I'd say, despite this micro competition, which is clearly higher, the mispricings at the asset class and industry level show no sign of diminishing. And that's because it's so darn scary to fight them. So where are investors pessimistic today? I mean, are there areas where the supply side is contracted, share prices are starting to recover, but without the broad participation of mainstream investors? Yes, and you know where I'm going with this. We've talked about the gold industry, but you can sort of describe that thesis to the commodities complex overall. And this graph you've probably seen before, it's done the rounds, shows the energy-heavy GSCI commodities index relative to the S&P 500. And the downward collapse in that ratio on the right there is what happens when, over a 5-year period, oil goes down big, gold goes down, agricultural commodities goes down, but the S&P rises 60%. So that's where we are today. And I think this picture does a good job of encapsulating the last 10 years. Any asset with cash flows that can be leveraged or reinvested has gone through the roof. If it's asset light, even better. Commodities don't generate much yield. They're certainly not capital light, asset light, and they've been left behind. So that could be the opportunity. Here we see a solid recovery of commodities off the bottom 2.5 years ago. It's a very long-term chart. But the recovery's been totally eclipsed by the S&P 500, by the FANGs, cryptocurrencies, cannabis stocks, you name it. So it hasn't generated much interest yet. Frankly, the stocks in these commodity industries also have lagged. I mean, oil services being a good case in point, is barely off the lows 2.5 years ago, whereas the price of oil has doubled. So I'd like to leave you with some thoughts from a white paper 2 years ago on the natural resource and energy industry by Jeremy Grantham and his team at GMO, where they extol the virtues of investing in energy and resource equities. And they articulate very effectively, better than I could, lots of data, what I'd been thinking in the past years. And the conclusions, I think, are just as valid today as they were 2 years ago. And so consider some of these merits. Diversification. Resource equities are reasonably uncorrelated with the broader stock market, and that the diversification benefit increases with holding periods. We know that resource equities generally protect against inflation and hold purchasing power during inflationary periods. They actually perform better than the market over the very long term, which is surprising, but because they trade at a big discount normally, and that's because they're volatile and unpredictable, they've actually outperformed the broader market. They're cheap, maybe a little less cheap than they were 2.5 years ago, but I think that's still valid, suggesting future returns are quite high. The last two are actually very interesting. Low allocations. The weight of energy and materials in the S&P 500 has gone down by about 50% over the past several years. So large institutions are really just underexposed. And lastly, value investors tend to be somewhat averse to investing in commodity-related industries for very good reasons. But there's a chance that the competition here might be a little bit lower from mainstream value investors. So just wrapping things up, I'd like to just leave you with 3 points, if I could. The first is to look for misunderstood companies in unloved industries, and we've talked a lot about precious metals. You could talk about oil services, other areas. Second, as value investors, keep an open mind about cyclicals and commodities, at least during the upcycle. And third, I would say make sure you avoid my mistakes, and let me be specific about that. So if you see blood on the streets, you're probably 2 years too early. On the other hand, if you see a popular mania developing, sell as much as you can so you can sleep at night, but maybe strap on your seatbelt, because a lot of the return is going to happen right at the end. And brings to mind a quote by Rick Rule, who is the chairman of Sprott USA, pretty well-known figure in the industry, where he says, if you've suffered through the pain, stick around for the gain. So, thank you.
Yes, hello. Can I thank you for the presentation. I also share your interest in following gold stocks. So about this company, it seems that there is a controlling shareholder, this kind of GZ, Golden Valley Mines, which is also listed. So can you tell us a bit about the relationship? And then what is the current cash flow before Malartic expansion starts? Are they generating any cash flow from royalties? And if yes, what is the annual cash flow? And finally, is Malartic still a JV, or is it owned by Agnico now in total? Or am I wrong about that? So thanks.
Yeah. So Golden Valley Mines owns 51% of Abitibi Royalties. It's publicly listed, so if you believe in stub trades, you could go buy Golden Valley Mines, but you'd have to assume that they're going to spin out Abitibi Royalties, which I don't think is going to happen based on my conversations with Ian. So that's question or answer one. Answer two, cash flow. So the company generates a little bit of cash flow right now, but not much. So it receives dividends from Agnico Eagle and Yamana Gold, which are substantial equity holdings on the balance sheet. Ian Ball, he sells covered calls and uncovered puts to kind of trade the range in those stocks to generate yield. So that's a source of income. So while there's no producing properties under the royalty yet, there is a couple $1 million of cash flow from those sources. This year, one of their smaller royalties comes into production. It's also a near pit zone, the Jeffrey zone or Barnett zone, and that should start to generate cash flow, which I alluded to will help this cash flow go from 2 to 4 million or so over the next few years before the Odyssey North comes into production. And then, what was your third question?
The third question was whether Malartic is still a joint venture between Yamana and Agnico, or
yes,
it is still
50-50.
50-50. Okay, just to get an understanding, what is your estimate of when the expansion starts? What would be their annual royalty, you think? from that area, from that part, and for how long?
So I don't have my model in front of me, but Odyssey North comes into production about 5 years from now. You know, so it's 2023 or so. Okay, and then I think it continues for a very long period of time. There's also a portion of East Malartic, which was on that picture I showed you next to the Odyssey North zone, which Abitibi Royalties NSR covers part of. So furthermore, a lot of mining was done historically at shallow depths in the East Malartic area, and mining stopped there, but underneath, so deeper down, there's a large amount of resource, some of which falls within Abitibi Royalties and our NSR. So with mining technology having improved, that's accessible now. So I can talk with you later about some of the assumptions, but it's, you know, it sort of ramps up into sort of full, you know, full contribution, if you will, in sort of 2024.
But for the next 4 or 5 years, I guess they need to stay at the current level. So it's not an exciting prospect of cash flow generation for the next 4 or 5 years. Of course, you have this huge opportunity, but is that
huge
right?
opportunity, long term. Shorter term, they have this other royalty coming into production, so that's actually cash flow.
Okay.
That's covered by another royalty. And then, you know, you have this cash on the balance sheet plus securities, which could be reinvested. Depends how that goes. So yeah.
So I just have two quick questions. So there's 39% of market cap in cash and securities. Would you prefer they sold some of the equity stakes and bought back their own stock at a discount if it's 0.6 times book value? And also, how are they doing that in terms of, is it in the market or a tender offer? And B, for this company, they're obviously investing, but on a more of a macro level, where are we in the capital cycle with gold more broadly?
Okay, so the first point is this is a very liquid stock. Unfortunately, it's not appropriate for the vast majority of institutions. As I said, the market cap's about 110 million. 17% is owned, actually more, by insiders, a very stable capital. 51% is owned by Golden Valley. So there's a small amount of free float, doesn't trade much. You're lucky to get shares on any given day, frankly. So that's kind of the challenge. Ian Ball has stated he wants to reduce the share count from 11.4 million shares outstanding to 10 over the next 3 years. And so I think he'll be able to do that. So that's kind of the buyback activity, if you will, which I sort of incorporate into my estimates. And then your second question about the capital cycle is, I think we're you know, mid-cycle at the very latest for the gold industry. You know, I think you know, very valuable properties are attracting a bid now. The largest gold miners have depleting assets; they're shrinking, and eventually investors are going to switch 180 degrees and tell them to start growing again. When that happens, they're going to be deploying capital into M&A again. You're seeing it selectively, but that activity will pick up. So I think we're still pretty much in the sweet spot. Meanwhile, of course, as I described, the industry is very unloved. Like, there's no institutional capital that's, you know, allocating to it in any size.